Okay, good evening, everyone who's in North America, and good day to those of you that are elsewhere in the world. Tonight's presentation is, as Dave mentioned, the first of 3 sessions that we're going to have on programming adaptive strategies in AmiBroker. This is a follow-on to a presentation that I did to the AmiBroker Canada group a while back on the benefits of adaptive strategies, and the feedback from that was, hey, that sounds great, now show us how to actually do it, instead of just telling us why it's a cool thing to do. So that's what this course is all about. All right, so our real objective here is to walk you through all the steps, or most of the steps anyway, in developing an adaptive trading strategy. I say most of the steps because we're not actually going to talk much about the underlying strategy, right? We're going to talk about how to take a strategy that you've already developed and morph that into an adaptive strategy. So at the completion of the course, the things we'd like to be able to do are to define a market regime, consider how your trade setups, entries, and exits are assigned to a regime, summarizing the metrics by regime, and then perhaps most importantly, modifying your AFL to use adaptive regime-specific parameters, and then finally to compare the adaptive strategy performance back to a baseline, because we want to know if it actually worked or not. A few things to get out of the way first. One is to keep in mind that with this course, as well as the CBT course that we did in November, my goal is not to show you the one and only way to accomplish any particular task. I'm trying to show you a way to show the task. You know, really programming is as much art as it is science, and different people will have different goals and different priorities when they write code. So for example, sometimes I will sacrifice a bit of brevity, if I think that the code will be more readable and therefore more maintainable if I write something out in a slightly longer style. I do always strive to make my code as efficient as possible from an execution standpoint, and that's because I'm often running optimizations that may have hundreds or even thousands of different variations, and I prefer those to finish in a few hours rather than a few days. But that said, you know, like all of you, I'm still learning AFL. I know a lot. I've been using it for quite some time, but I also frequent the AmiBroker forum, and I see different people have different ways, better ways, faster ways to do some of the same things I've been doing for years. So, you know, the goal for all of us, I think, is you first build up a set of skills, and then over time you refine them to get better and better as time goes on. All right, so class prep. Hopefully everybody has done these things, but you should have AmiBroker 6.0, preferably 6.2 or later, installed on your system with a working data source. I personally like Norgate NDU, but you can use whatever you want. And you should have some familiarity with AFL and the CBT, which all of you who went through the CBT Intensive course with me should already be familiar with that. All right, so before we really get started here, I'm going to give you a quick lesson in something that will increase your street cred a bit when you're interacting with professional programmers. And it won't necessarily earn you respect by doing this right, but at least it won't count as a mark against you if you do it wrong. So the lesson is on vocabulary, code versus codes, and there's 2 links on this page that both talk about kind of the same thing. But specifically, in the realm of computer science, code is used as a mass noun, meaning it specifies a collection of instructions in a specific arrangement as a whole and in no specific quantity. So whether you're talking about 1 line of code or 10 pages, it's still referred to as code, not codes. So some other examples of mass nouns. Sand. water, peanut butter. Nobody says, I have 3 sands, right? That sounds very weird. I have 7 peanut butters. Also not something that you would typically hear people say. If somebody did say, I have 7 peanut butters, you would probably interpret that as, I have 7 jars of peanut butter, right? But not peanut butters per se. So the lesson is, no matter how many different programs you write, or scripts, or AFL files, or anything else, that collection of things is still code, singular, and not codes. And I say that only because I'm seeing more and more people use the term codes, and all the computer science majors and other programmers I know cringe every time they hear that. And I see Dave's comment that he said that's geared towards Marcel, and it's not geared just towards Marcel, because I see lots and lots of people saying codes. I need the codes for this. I wrote the codes for that. No, you did not. So anyway, that's my little soapbox lesson for tonight. With that, let's get on to the real session. I will tell you ahead of time, tonight we have about 44 slides to go through, and slides and depth of content don't necessarily go hand in hand, but there is some correlation. Our CBT course, the entire course from start to finish, was about 65 slides, and it took us somewhere between 4 and 5 hours to go through all that. So we have a lot to go through tonight. My suggestion is, buckle up and get ready. I will answer as many questions as I can, but if I go too fast through any of this, feel free to send me follow-up questions through the AMI Broker Courses site. All right, so our overview for session 1. Our end goal, obviously, is to create an adaptive strategy which performs optimally under different market regimes. And the first step toward that goal is to be able to summarize any metrics that we think we might need to make a decision on best, what's the best variation of our strategy for a particular regime. Sorry, I lost my train of thought there a little bit. So we want to summarize all those metrics so we can pick the best variation of the strategy for each regime. And then this session is specifically about getting those regime-specific metrics. So the things we'll talk about tonight, just at a high level. We're going to talk about defining market regimes, how we go about that, what are some things to think about, how we're going to implement those, so market regime functions, market regime assignment, so how do we associate trades with regimes, and then finally, just some things to think about in terms of reporting your metrics and how to do that efficiently. This slide is basically pulled from the Adaptive Strategies overview presentation that I gave to the AMI Broker Canada group. If you haven't seen that, that presentation is available, I think, on the AMI Broker Canada site, and definitely on my website, quantforhire.com, as well, if you need to review. But there were basically 9 steps that we talked about as part of that strategy of creating, or that process of creating an adaptive strategy. And those are on the slide in front of you, 1 through 9. I'm not going to read them all to you. You can read them yourself if you like. But the ones that are in red are the ones that session 1 will focus on tonight. So primarily looking at defining market regimes and summarizing the metrics of interest by market regime. Just to give you a little bit of a framework that you can hang this on. And we'll come back to this slide and before the second and the third sessions as well, so you can see how we're kind of progressing through the steps. All right, so step 1, defining market regimes. The first thing that you need to think about if you're going to build an adaptive strategy is, what is your market? If we're gonna make our strategy change its behavior based on the state of the market regime, then you have to have some concept of what the market is. So if you're trading stocks, it's likely that you're trading mostly stocks from a particular index. So that index as a whole could be your market. So OEX, the S&P 100, SPX, the S&P 500, RUT, the Russell 2000. If you are trading other markets, if you're trading futures or you're trading Forex or something like that, then you'll have to decide if there's a single entity that's a good representation of the market as a whole. I don't really do a lot of trading in those markets, so I don't have strong suggestions for what you would want to use. But if you do trade them regularly, then you probably have a very good idea of, how can I get an idea of what, quote unquote, the market is doing today. The next question you're going to want to ask yourself is, what time frame is appropriate for your trading style? If you're day trading on 1-minute bars or even on tick data, you probably don't much care what the S&P 500 5-year trend is, right? You care about how the S&P 500 has been behaving maybe over the past few days, and that will hopefully give you some hints about how it will behave today for your day trading. Likewise, if you are trend trading and you tend to hold your trades for anywhere from 3 months to a year, you probably don't want to be doing things like looking at the VIX, right? The VIX has basically got a 30-day look ahead on it, 30-day volatility look ahead, which might not be very relevant if you're planning to hold your trades for 3 to 12 months. Once you have those two things decided, the next thing to think about is which market factors you believe influence the behavior of the instruments that you trade. So let's stick with the stock example. Perhaps I think that the current trend of the S&P 500 index has an effect on which way the individual stocks are likely to move. Maybe I would think about things like percent rank. So where is the S&P 500 index today compared to where it's been over the last year, let's say? So we would look at today's value, we would look at all the values from the previous 252 trading days and say, okay, on a percentile basis, where does today's value rank, today's price rank? And if it's very low in the percentile ranking, maybe we'd say, well, that's kind of my definition of bearish. Some people might define bearish as a downward trend. Other people might define bearish as, well, I'm kind of trading in the lower part of the range or in the lower percentile. Volatility can certainly be a factor, especially with stock trading. So how volatile has the S&P 500 index been compared to where it usually is? With volatility, there's very seldom a specific threshold that we can say above or below, but we can certainly look at it compared to where it's been over a sort of a medium-term history, medium-term being relative to your trading durations. And then finally, seasonality could be a factor that influences your trading, especially for people that trade commodity futures. Animals and plants, grains, etc., have very definite seasonal trends. So, that may be something that you work into your trading as well. Probably less relevant for people that trade stocks, ETFs, and options. All right, so you've got this idea now of how you're going to define your market, what kind of time frame you're looking at, what factors to look at within that market. The next thing to think about is how many different states do you want to define for each one of those factors? So for example, if we choose the trend and volatility as our two factors, we might have 3 different trend states: bull, bear, and sideways, or bull, bear, and neutral. Pretty common trend states. And we might have 2 volatility states: quiet and volatile. You may have more, you may have less. Those 6 combinations of trend and volatility basically give you the 6 market regimes that you will have seen if you've studied any of Van Tharp's work. But honestly, any way you want to define it, is fine, and it's going to probably be an iterative process, right? You're going to define your regimes, you're going to think you've got it all figured out, and then you're going to do some testing, and for one reason or another, you're going to say, those actually weren't very good definitions. Maybe I should go back and try again. And maybe try again means, oh, I just need to tweak the thresholds. Volatility, instead of being in the top 50th percentile or in the bottom 50, maybe that's not a good division. Maybe it's 35 and 65, or maybe it's 80 and 20. Who knows? Your refinement might also be, hey, you know what? I think I need more than 2 volatility states. I really think I need 3. Or, hey, I don't think I really need 3 trend states. I think I just need 2 trend states. Or I think I just need to define volatility a different way. I've been looking at historical volatility, and maybe I should be looking at implied volatility as communicated by the VIX. There's all these different ways that you can go back and change your regime definition. So don't expect to get it necessarily perfect on the first try. In the example that we will ultimately work through, and the example that I used in the previous presentation, there were only 4 market regime types. So there were only 2 trend types, bull and bear, and 2 volatility types, quiet and volatile. All right, so some things to think about as you're defining and then doing some testing on your market regimes. One of the first things is you want to see how often each regime occurs. So look at some long period of time and just map out what your different market regimes are on each day or each bar, but probably each day. You don't want to be changing market regimes more often than that. But see how often they change. So as a very rough guideline, you can take the number of regimes that you have and divide that into 100% and say, okay, that's about how many in an ideal world I would like to see of each market regime. So if we have 6 different regimes, that says that each one should take a little bit under 17% of the total number of days in our testing period, our evaluation period. You're never going to get a market regime definition that divides your days exactly evenly. So I think, again, a good rough goal, and you can change these as you see fit. There's no magic behind this. I haven't done any huge studies to see what the perfect numbers are. But I think a reasonable goal is to say, I don't want any regime to be more than 2 times that baseline, so no more than 33% or so in this case. And I don't want any one regime to be less than half of the baseline, so I don't want to see anything less than 8%. Now, if my least used regime happened to be 6.5%, would I say, oh, well, I've got to throw out my definitions because I fell below that half of the baseline? No, I would not. I would say, okay, 6.5%. We know that some types of market behavior occur less frequently than others. Again, going back to Van Tharp's work, he will tell you that quiet bear markets are relatively unusual compared to the other market types, because usually when the market gets bearish, volatility rises. So to have low volatility and bearish price behavior doesn't happen that often. So if I was using the 6 Van Tharp market regimes, I would probably say, yeah, if I see that the quiet bear is only 5%, 6%, 7%, I'm probably okay with that. If it's 1 or 2%, I would probably go back and say, well, maybe I haven't defined my regimes very well. I'm okay with quiet bear being a smaller slice of the pie, but it's got to be bigger than 1 or 2%, or it's basically useless to me. Another thing to look at as you're evaluating your market regime definitions is you don't want them to change too often. It's inevitable that the regime will sometimes change while you're in a trade. That it's just going to happen, right? So not every trade is going to enter and exit in the same regime. What we don't want is for the regime to be changing multiple times during a single trade. And it's not really that it's an issue for that trade if the regime changes multiple times. But it is a sign that it probably makes it hard for you to determine what the correct market regime is to use on a given day of trading. So for example, if you're primarily a swing trader and you have trades that last, somewhere between 3 and 10 days with an average of a 7-day holding period, if your market regime is changing every 2 days, every 2 or 3 days, so on Monday it's one thing, on Wednesday it's something else, on Friday it's changed again. On Thursday, how confident are you going to be that the market regime that's showing up for Thursday is really an accurate market regime and it's not just going to instantly change, which would have pushed you to different strategy parameters? You want that market regime to be changing slowly enough that you're like, oh, we're in quiet bull market right now. That's probably going to last for a while. So, yes, it could change at any time, but I feel pretty good about using my quiet bull strategy parameters.